Sarah earns $95,000 a year. She did everything right. She skipped vacations. She cooked at home. She drove the same car for 8 years. By 2024, she had saved $80,000 for a down payment. More money than most Americans have in total savings. She opened Zillow and discovered that the monthly payment on a home she could afford in 2021 now only buys something 40% smaller, in a neighborhood she didn't even want. She closed the app. She sat quietly, and she thought, did I do something wrong? She didn't. The game changed. And here's the part that nobody prepared her for. The strangest part of this housing crisis isn't the prices. It isn't the mortgage rates. It's something hiding quietly underneath both of them. Something that most economists mention briefly in reports that nobody reads. And by the end of this video, you're going to understand it completely. Let's go back to what most people believed would happen. When the Federal Reserve started raising interest rates aggressively in 2022, many economists and housing analysts expected home prices to fall. The logic was straightforward. When borrowing money gets expensive, fewer people can afford to buy. Demand drops. Sellers panic. Prices fall. That's how it worked in 2008. That's how it worked in previous cycles. And by mid-2022, housing sales had already dropped dramatically. Existing home sales fell to their lowest level in over a decade. Many investors were quietly waiting for the crash to begin. But then, something unexpected happened. Prices didn't crash. In many major markets across the United States, prices barely moved. In some cities, they actually climbed higher. And the people who spent months waiting for that crash missed out entirely. So what went wrong with the prediction? Here's where the first twist comes in. Demand dropped. That part was true. Mortgage applications fell nearly 40% from their 2021 peak, according to the Mortgage Bankers Association. Fewer people were actively shopping for homes. But here's what the prediction completely missed. Supply collapsed even faster than demand. Think about it like a parking lot at a sold-out concert. Yes, fewer cars are arriving. But the people already parked? They're not leaving either. So the lot stays full. Nobody gets in. And the few spots that do open up? People fight over them desperately. That's the U.S. housing market in 2026. According to data from the National Association of Realtors, housing inventory in many major markets sits at roughly half of what would be considered a balanced market. A healthy market has around 5 to 6 months of available supply. In many cities today, that number is closer to 2 months. In some areas, even less. But here's what's really driving that shortage, and this is the part that most people, even smart people, completely overlook. Because what's actually keeping inventory so low isn't what you think. It's not builders. It's not banks. It's the people who already own homes. And when you understand what they discovered and why they're absolutely refusing to move, you'll realize this problem could last far longer than anyone is predicting. Stay with me. Between 2020 and 2021, millions of Americans locked in 30-year mortgage rates between 2.5% and 3.5%. At the time, it felt almost too good to be true. Today, the average 30-year fixed mortgage rate sits around 6.5% to 7%. That might not sound like a huge jump, but let's run the actual numbers. On a $400,000 home at 3%, your monthly payment is roughly $1,686. At 7%? That same loan costs you $2,661 per month, nearly $1,000 more, every single month. That's over $11,000 extra per year. Now ask yourself honestly, If you owned a home with a $1,686 monthly payment, would you sell it and immediately take on a $2,661 payment for a similar house? Most people wouldn't. Most people can't. The Federal Reserve Bank of New York estimates that roughly 60% of existing mortgage holders have rates below 4%. These homeowners are essentially locked into their properties not by law, but by math. Economists formally call this the lock-in effect, and it has removed millions of potential listings from the market at exactly the moment when buyers need them most. Now here's where it gets more complicated, because what I just described is only part of the story. The real reason this market is broken goes even deeper, and it connects to a decision, or rather, millions of small decisions made over the past 2 decades. For roughly 15 years, following the 2008 financial crisis, America dramatically slowed down home construction. Builders were cautious. Banks were tightening lending. Local governments weren't approving new zoning. And so, while the U.S. population kept growing, adding households, adding families, adding demand, the supply of new homes fell further and further behind. According to a 2024 analysis by Freddie Mac, the United States has a housing shortage of approximately 3.8 million homes. To visualize that, imagine every single seat inside the largest 50 NFL stadiums in America combined. That's roughly how many homes are simply missing from the market. Not overpriced, not unavailable, just don't exist. And here's a number that puts the human cost of this in perspective. The median age of a first-time homebuyer in America has reached 38 years old, the highest ever recorded by the National Association of Realtors. A generation ago, that number was 29. People aren't buying later because they want to. They're being pushed out of the market for longer than any previous generation. But wait, there's still a twist you haven't heard yet. Because while regular buyers like Sarah are frozen saving longer, waiting longer, hoping longer, there is a specific group of buyers who have been quietly, methodically purchasing properties across the country. They don't apply for mortgages. They don't worry about rate changes. And the more chaotic and confusing this market becomes, the more money they make. Here's who they are and why this changes everything. Cash buyers and institutional investors have captured a disproportionate share of available homes during this period of frozen inventory. According to data from CoreLogic, investors ranging from large institutional funds to smaller local landlords accounted for roughly 26% of single-family home purchases in recent years in certain markets. In some Sunbelt cities, that number was even higher. And their advantage is simple. When mortgage rates rise from 3% to 7%, a cash buyer's cost doesn't change at all. When inventory is low, they simply offer more. When the market is confusing and emotional buyers hesitate cash, buyers move immediately. Ask yourself this honestly. If someone offered you 2 identical houses but told you one might drop in value over the next year, would you buy today? Most people would pause. Most people would wait. Institutional buyers don't pause. They run a spreadsheet. They make the offer. And they collect the rent from the people who are still waiting. This isn't a conspiracy. It's just what happens when emotion meets math and math moves faster. But here's the part that surprises most people. Even this investor story isn't the biggest force shaping where the housing market goes next. There's a demographic reality quietly building underneath everything, and it's something that almost nobody is talking about. The largest generation in American history, Millennials, is now fully in their prime home-buying years. Roughly 72 million people between the ages of 28 and 43 are either already trying to buy their first home or will be over the next decade. At the same time, according to data from the National Association of Realtors, homeowners are now staying in their homes an average of 10 years before selling nearly double what it was 2 decades ago. Fewer homes turning over. More buyers competing. A shortage of 3.8 million homes that isn't going away quickly. These three forces, the lock-in effect, the construction deficit, and demographic demand, aren't temporary. They don't resolve in a year or two. They are structural, which means the people expecting a sudden crash back to 2019 prices may be waiting for something that simply isn't coming. But here's the question that actually matters, and it's the one most finance channels never answer directly. Given everything you just learned, the shortage, the locked-in homeowners, the investors, the demographic wave, what should a real person actually do right now? Because there is a clear, logical path through this, and it doesn't involve timing the market perfectly. It involves understanding one simple thing. Let me show you. Here's what the data and the psychology together are telling us. First, waiting for a dramatic crash may not be the right strategy for most people. A crash requires a sudden surge of supply, millions of homeowners deciding simultaneously to sell. The lock-in effect makes that unlikely at current rate levels. Prices could soften in certain markets. But a nationwide collapse? The structural evidence doesn't strongly support it right now. Second, if you're a buyer today, your benchmark needs updating. Stop measuring against 2021 rates. Instead, ask a simpler question. Can you afford the monthly payment comfortably with your current income? And do you plan to stay at least 5 to 7 years? If both answers are yes, the math often still works in your favor. Not because of dramatic appreciation, but because every payment builds equity instead of funding someone else's investment. Third, if you're not ready, that's completely legitimate. But use the time deliberately. A larger down payment doesn't just reduce your loan, it reduces your monthly payment, improves your rate, and gives you negotiating power when inventory briefly opens up. The buyers who will win the next opportunity aren't the ones who predicted the market. They're the ones who were quietly prepared when the moment arrived. Every single generation has looked at the housing market and thought the same thing. This is impossible. This is the worst it has ever been. I missed my chance. The greatest generation said it after World War II. Baby boomers said it during the inflation of the 1970s. Millennials said it in 2006, right before the crash, and they said it again in 2021, right before the freeze. The truth is this: every generation faces a different impossible. The question was never whether the market would be fair. It rarely is. The question is whether you understand the game well enough to find your move within it. The people who win in housing and in personal finance generally are never the ones with a perfect prediction. They're the ones who replaced panic with preparation, who replaced assumptions with understanding, and who made calm, clear decisions while everyone else was either frozen at the four-way stop or rage-clicking on Zillow at midnight. You now know more about the 2026 housing market than most people will ever bother to learn. What you do with that understanding is up to you. If this video helped you see things differently like it, subscribe and share it with someone who's still waiting for 2021 to come back.